It's confirmed. The Australian economy is in a per capita recession. But what does it mean for you? What does it actually mean for the economy? And what does it mean for property price growth going into 2024? I'll cover all of that and more in this episode. Hi, it's Nero here, and let's begin by looking at the Australian National Accounts, the National Income, Expenditure and Product data from the Australian Bureau of Statistics. Now, when you look at the high-level statistics, the key statistics as they call it here in this page, it says the Australian economy rose 0.4% in seasonally adjusted chain volume measures. But then how can we be in a recession or a per capita recession if the economy actually grew? I'll answer that question in just a moment. Then we see that GDP rose 3.4% in 2022 to 2023, terms of trade fell 7.9%, and housing saving ratio decreased to 3.2% from 3.6%. Now, this doesn't tell you the story, right? Here's where we need to look at the data. So if we look at the June quarter key figures and the percentage changes, what you can see here in the column March 23 to June 23, GDP did grow 0.4%, but it's the next figure, GDP per capita, GDP per person fell 0.3%. And you can see it fell 0.3% in the December 22 to March 23 quarter. So that means that we've had 2 quarters of negative growth in GDP per capita. And a recession means that you have 2 consecutive quarters of negative growth. So that's what it means when we say Australia is in a per capita recession. So how can we not be in an actual economic recession, but be in a per capita recession? Well, if we look at this chart, which tracks net visa arrivals, again, the source of the data is the Australian Bureau of Statistics, you can see that the red line, which is net total visas, not including visitors, has actually increased substantially. Our migration levels into Australia are the highest they've ever been. But what that means is that the economy is not growing at the same rate as our population is growing. Total GDP, which is the economy growth, that's growing by, say, this much, but our population is growing by, say, that much. So therefore, the economic output, economic growth per person is actually shrinking. Put another way, it shows that the RBA's increase in interest rates is working. We're spending less per person. And here's proof. For the first time in more than 2 years, the ABS household spending indicator recorded an annual drop. Australian households spent 0.7% less in July 23 compared to 22, the first annual decline since February of 2021. Now remember, early 2021, there was a lot of easy money being thrown around in the economy. Interest rates were at record lows. Discretionary spending dropped 3.3% throughout the last 12 months as Aussies responded to tough economic conditions by curbing spending. Non-discretionary spending still grew by 1.7%, but again, this is the lowest annual increase since 2021. So what's non-discretionary spending? It's things we need to spend money on that we don't get a choice about. Electricity prices, insurance prices, these are the non-discretionary spending items, at least some examples of them. But if we come down and have a look at this chart, it really highlights what's been happening. So we've got from January, annual change to spending on goods. So in January, we were increasing our spending by 6.1%. But since then, you can see it started to decline. And since April, we've started to spend less, or at least the annual change to spending on goods has been decreasing. Now, if we look at the other column though, which is annual change to goods price inflation, we're seeing that in January it was 8.47%, but it's been coming down and it's now sitting at 4.36%. And yes, this is higher than the Reserve Bank's target of 2 to 3%, but the fact is it's coming down and coming down rapidly. If you look at the annual change to goods price inflation, in January it was 8.47%. In July it was 4.36%. That's a reduction of about 50%. That's really, really fast. And the RBA actually doesn't want inflation to keep falling at that rate, because if it keeps falling at that rate, it's going to go down, down, down and crash through the floor. And then we get what's known as negative inflation, or more accurately, deflation, which has all sorts of negative ramifications for the economy. So the RBA now has to be careful. We're in a per capita recession. Inflation is starting to fall. People are starting to spend less and less. So now, yes, things are heading in the right direction, but they need to slow the trajectory. They need to slow how quickly our inflation is falling. And how can they do that? what's the only tool they essentially have at their disposal? It's to cut interest rates. Here's what the major lenders say about when interest rates will be cut. Australia's big four banks are forecasting interest rate cuts in 2024, with one major bank expecting rate relief as early as March. Commonwealth Bank, Australia's biggest bank, believes the cash rate has peaked and has predicted an interest rate cut in March of next year, so essentially in about 6 months' time. Based on our current forecast for economic activity, prices and the labour market, the RBA could cut the cash rate in March 2024, but the clear risk is a later start date to the easing cycle, CBA senior economist Belinda Allen said. CBA expects a total of 4 interest rate cuts over 2024, taking the cash rate to 3.1%, a level it considers a more neutral cash rate stance. Westpac, NAB and ANZ believe the RBA will start cutting interest rates later into 2024. Westpac expects interest rates will start falling from September next year, with another rate cut in December to bring the cash rate down to 3.6%, or 0.5% lower than it stands right now. NAB believes there's still a possibility of a further 0.25% rate hike this year, bringing the cash rate to 4.35%. It then thinks rate cuts will begin in August 2024. ANZ believes the RBA has also finished hiking rates in this current rate cycle and will make its first cut in November 2024. So the fact is, the per capita recession we're in right now will force the RBA to cut rates at some point next year. The different lenders are just arguing about what month that's going to happen. None of us have a crystal ball, but the odds are rates will fall next year. And mind you, this is in line with what's expected to happen in the US as well, with rate cuts to start there in 2024. So it seems that rate cuts are on the way next year, but what does that mean for property prices? Well, consider this. Property prices in 2023 since February have risen significantly across the country. Sydney leading the way at 9.2%, followed by Brisbane, Perth, Adelaide. And many regional markets have grown as well. That's when interest rates are at the highest they've been in for over a decade. And as you can see in this next chart, which tracks Australian home prices versus capacity to pay, the red line, which is the actual median home sale price, you can see that's actually had an uplift, while the blue line, which is the capacity to pay for a borrower with a 20% deposit, in other words, people's borrowing capacities, has taken a nosedive. Now, what happens when interest rates start to fall and people's borrowing capacities start to increase? Well, that's going to put further demand on property. And are we building enough homes? I've spoken about this in the past. We are not building enough properties. As you can see in this next chart, which looks at dwelling completions versus population change. The red line is population growth. You can see we're on a tearaway at the moment, and it's still going to settle at well above our long-term averages. But then the blue line, which is the number of properties being built, is dwindling. So the fact is we're not building enough properties for the number of people coming into this country. Now, yes, the federal government's Housing Australia Future Fund has been approved. It's $10 billion set to come into law. But how many properties is that going to add to the market? 30,000. Now, that might sound like a lot, but when you look at this next chart, which actually shows you how many people are set to come into this country over the next couple of years alone, in 2023, we've got a total of over 400,000 people. In 2024, it's over 300,000 people. That's over 700,000 people. Now, let's assume you have roughly 2 adults per household. That's an extra 350,000 households. 350,000 households coming into the country in 2 years. We're building 30,000 homes in the next 5 years, assuming we can even get that many built. And I'm very skeptical that we can. So the fact is that with interest rates to be cut, which will increase people's borrowing capacities, a massive housing shortage, and the fact that we still have the stage 3 tax cuts to come in from the middle of next year, it certainly seems that most people's borrowing capacities are going to be increased. So this per capita recession that we're in is going to cause a lot of chaos. It's going to cause a lot of confusion. But when you look through the data, when you see what's actually happening, you can see that what this will do is force so many other things to come into play to stop Australia from going into a full-blown recession. But all of those factors, as I just mentioned, lowering of interest rates, continued increase in migration, tax cuts to come, not enough properties being built, all these factors will point towards property price growth being quite significant in 2024. So that's why, if you're thinking about buying an investment property and you can afford to do so, the sooner you do, the better off you will be. At least, that's what the data seems to indicate.